Gold struggled to capitalize on its modest intraday gains on Thursday, instead met with some fresh supply near the $1,785 region. The xauusd extended its descent through the early North American session and dropped to fresh daily lows around the $1,744 area in the last hour. The commodity has now eroded a part of the previous day's positive move that followed the U.S. CPI report, which eased fears about an early withdrawal of the stimulus by the Fed. However, the Fed officials have started to guide the market towards early tapering and higher interest rates as soon as 2022. This in turn acted as a tailwind for the U.S. Treasury bond yields and kept a lid on any meaningful gains for the non-yielding yellow gold. A modest uptick in the U.S. Treasury bond yields along with upbeat U.S. macro data extended some support to the U.S. dollar. This was seen as another factor that undermined the dollar-denominated commodity that said uncertainty over the likely timing for policy tightening by the Fed held traders from placing aggressive bets, directional bets, and helped limit the downside for gold. Hence it will be prudent to wait for some follow-through selling before confirming that this week's goodish rebound from the flash crash to the lowest level since March has lost steam. Previous update: gold price is holding the higher ground above $1,750, looking to build onto its recovery from 5-month lows as the U.S. dollar nurses losses amid fading hawkish Fed expectations and weaker Treasury yields. The U.S. July CPI report showed signs of inflation peaking, cooling expectations of an imminent Fed's tapering. Meanwhile, concerns over the economic impact of the spread of the Delta COVID variant globally also underpin gold's safe haven appeal. Looking ahead, all eyes remain on the U.S. PPI and jobless claims data to sustain the recovery momentum above the $1,750. Psychological LVEL technical confluences detector shows that gold has eased from a critical barrier at $1,759, which is the intersection of the previous week's low and the previous high. 4-hour acceptance above the latter is critical to unleashing further recovery gains towards $1,763. The pivot point 1-day R1. The next powerful resistance is aligned at $1,766. The previous month's low. A sustained move above that level could trigger a rally towards $1,775. At that point, the Fibonacci 23.6% 1-week pivot point 1-month S1 and SMA 54-hour meet on the downside. The $1,752 demand zone offers immediate support where the SMA 54-hour previous low 4-hour and Bollinger Band 1-hour middle converge. The Fibonacci 23.6% 1-day at $1,747 could emerge as the next relevant support. Further south, $1,743 will be the level to beat for the bears. That level is the confluence of the Fibonacci 38.2% 1-day and SMA 10 4-hour technical confluences detector is a tool to locate and point out those price levels where there is a congestion of indicators, moving averages, Fibonacci levels, pivot points, etc. If you are a short-term trader, you will find entry points for counter-trend strategies and hunt a few points at a time. If you are a medium to long-term trader, this tool will allow you to know in advance the price levels where a medium to long-term trend may stop and rest, where to unwind positions or where to increase your position size.